BlackRock just quietly moved $2 trillion. Not rumours, not opinions, not clickbait headlines. Real money. And almost nobody is paying attention. In this video, I'm going to tell you where that money is actually going, why it's happening right now, and most importantly, how normal investors like you can position yourselves before this becomes obvious. Because what you're watching at the minute isn't noise. It's probably the early stages of a global wealth transfer. Why this matters more than any headline. Just to be 100% transparent, this info isn't based on an article or story covered on CNBC. It's based on changes in BlackRock's reported regional exposures and fund flows. How trillions of dollars of portfolio exposure have gradually rotated towards non-US markets rather than a single $2 trillion cash move. Anyway, BlackRock isn't a YouTuber with an opinion, like me. They manage over $14 trillion. They sit inside your pension, your retirement accounts, your index funds. So when they move capital, they're not guessing. Larry Fink doesn't trade on emotion. He trades on probability, policy, and maths. And recently, BlackRock moved $2 trillion of exposure away from the US and toward non-US markets. That doesn't mean America is collapsing. It means returns are rotating. Like I seem to be saying a lot lately, I'm not an expert on the global economy. I'm just trying my best to keep up with what's actually going on to help me and you with long-term investing. How institutions move before the headlines. Retail investors like me and you normally react to news. Hopefully, if you watch videos on this channel, that isn't you. Institutions move before the news exists. They don't need certainty. They don't wait for permission. They watch currency trends, capital flows, policy risk, and then they reposition quietly. By the time CNBC explains it, the opportunity is already gone. That's why watching what institutions do, not what they say, is the real cheat code. If this type of info resonates, by the way, hit subscribe so we can learn together and build wealth together. The weak dollar problem most people ignore. Here's the uncomfortable truth. Even if your portfolio stayed flat last year, your purchasing power didn't. The US dollar weakened, which means your money buys less. Your returns quietly shrink and global assets gain an edge. This affects the US and the UK, pretty much everyone around the world, because the US dollar is the global reserve currency. When the dollar weakens, foreign investments get a double tailwind. 1, asset appreciation. 2, currency appreciation. That's how institutions protect buying power. The global rotation has already started. This isn't about abandoning US stocks. America will still likely lead in AI, dominate tech, control defense innovation. But capital doesn't care about past glory. It cares about future speed. Right now, money is rotating towards faster growth, younger demographics, better currency setups, and ignoring that rotation is the real risk. Again, I'm not an expert and I'm 100% not a financial advisor. My full disclaimer can be found below in the description. The ETF signals most investors miss. Let's talk positioning, not predictions. ETF 1, VWO, Vanguard's Emerging Markets ETF, gives exposure to countries like India, Brazil, Taiwan, and China. Young populations, growing workforces, long runways. This isn't a trade, it's a multi-decade bet on global growth. ETF 2, EWJ, Japan. Most people think Japan is dead money. That's outdated thinking, in my humble opinion. Japan is going through corporate reform, governance changes, shareholder-friendly restructuring. Add a weaker yen, export dominance and global brands, and institutions love the setup. This isn't a comeback, it's a reset. ETF 3, broad emerging markets. This is the institutional macro player, not betting on one country, betting on the world growing faster than the US. When institutions want exposure without picking winners, this is how they do it. This type of info is why I prefer global index funds over simply investing in the S&P 500. Why waiting for certainty kills returns. Here's a trap that destroys most investors. They wait, they want clarity, they want calm, they want confirmation, but certainty only appears after the returns have been made. Institutions don't wait for all clear signals. They move when things feel uncomfortable. Every major rotation feels scary, right before it becomes obvious. The gold shift most people don't understand. There's another quiet change happening. Gold is no longer treated as dead weight. It's now classified as a Tier 1 liquid asset for banks. That means major institutions can treat gold like cash, using it as collateral to create leverage. This isn't fear buying, it's structural demand. And whether you own gold or not, these rule changes impact your retirement. The real game being played. Markets are designed to emotionally hijack you. Red screens, breaking alerts, panic news, like what's happening with crypto at the start of 2026. The goal is simple. Get you emotional, get you reactive, get you to sell. That's how wealth transfers from the impatient hands to the disciplined ones. Smart investors don't panic, they reposition. Summary. Let me leave you with this. Your future self is watching the decisions you make today, now. Not your opinions, not your intentions, your actions. Long-term investing isn't exciting, I admit. It isn't loud, it doesn't feel urgent, but it is how freedom is built. If you want to protect your future self, stop reacting, start positioning, think globally, think long-term. And if you want to learn how to invest in low-cost global index funds, see below for a recent video.